Good afternoon, or possibly good morning, depending on where you're looking at viewing our webinar from today. My name is Scott Maurer. I'm with Advanta IRA, and I'm your host today for how to evaluate home price appreciation when investing in rental properties. I have Gregg Cohen joining me today to talk about that topic. But before we get into Gregg's presentation, I wanted to share with you a little bit about myself and Advanta IRA, and also buying real estate in that particular account. My name is Scott Maurer. I'm the Director of Business Development here at Advanta IRA. I've been here for a number of years, seen the ups and downs of the market today, and that's why I'm excited to have Gregg on today to talk about figuring the home price appreciation that factors into that. I'm also a licensed attorney, although I don't do any legal work on behalf of Advanta clients, and we'll go over that disclaimer here in just a moment. If you need to reach me on any issue related to a self-directed IRA, buying real estate in an IRA, or just simply an IRA question on distributions or some of the other rules associated with it, give me a call, shoot me an email. I'm happy to answer those questions for you. Again, whether you're a client or not, just give me a call, shoot me an email. We'll get your questions answered. But as I mentioned, a couple of things we don't do at Advanta is we don't provide any legal, tax, or investment advice. So the information we provide is for educational purposes only, including our guest host that we have on today. Gregg is going to be talking about his area of expertise, but with any webinar, with any seminar that we do, we always encourage you do your due diligence on the people that you're investing with, the investments that you're making. That's something that Advanta does not do. We do not endorse any particular party or investment advice. We're having today's webinar really for educational purposes. If you need advice from an accountant or attorney, let us know. Maybe we can put you in touch with one of the contacts we have who'd be able to help you out. A little bit about our company. We have over $1 billion in assets across the two offices, both here in the Tampa Bay area and also in Atlanta. For that over $1 billion in assets is over 7,000 active accounts. And the way we really set ourselves apart in the industry is twofold. One, our clients experience tremendous customer service in that every single account that we have gets assigned to one point of contact here at our office. You get an account manager assigned to you that gives you that point of contact and really anything you need regarding your account, whether it's a statement, handling a new purchase, etc. You go through your account manager to do that. That really a concierge level of service we found over the years to be very popular and successful in how we've held the investments. Like I said, we have offices in both Florida and Georgia, but we do work with people across the country, wherever you're located. I'm not sure if we have clients in every single of the 50 states, but I know we have them in the vast majority of them. We can work with anyone wherever they're located for their self-directed needs. Now, in addition to our customer service that we offer, the other area we set ourselves apart is really in our education. The events that we hold, today's event and webinar is part of that commitment to really providing cutting edge information and education to our clients and non-clients. Any of our contacts are welcome to any of our events. Not only the cutting edge information, but bringing in speakers in a variety of different areas. We've had attorneys on, CPAs, property managers. Obviously, we have a guest host on today to talk about home price appreciation and what they do at JWB. But all of our events are open and free to the public for you to attend. We also have an on-demand learning channel. You can go view any webinar, including this one today, where it's been recorded on our YouTube page. And we try to keep and publish up-to-date blog articles as well on different topics, not only just regarding self-directed IRAs, but investing in general. Now, for anyone on the call who maybe has not heard of a self-directed IRA, again, there may not be many of you. Many of you are clients or contacts. You're on our distribution list, but a lot of people who haven't heard of self-directed IRAs, it's mainly because the IRAs, the retirement accounts that are out there, are most typically invested in brokerage firms, banks and brokerages offering mutual funds, stocks, bonds as the investment products inside their portfolio. But the IRS regulations allow you to invest in a much broader range of assets. It's not just limited to stocks, bonds, and mutual funds. However, the IRS does not require each custodian to hold all of the different types of assets. That's why people are not familiar with self-directed IRAs. It's simply because, again, most individuals, and you see the stat here at the bottom, over 96% of Americans have their IRAs with a brokerage firm that is offering them only those products that they sell. They're not allowing for investments into real estate, private lending, multifamily real estate, et cetera, the different investments you can make. because they don't have to. And again, most people not looking for those alternatives, although obviously with the changing market conditions we're seeing these days, individuals much more start looking for different investment alternatives to have in that portfolio so that you don't continue to ride that stock market roller coaster. Now, as far as what accounts can be self-directed, any type of IRA, whether you have a traditional or Roth account as an individual, if you're self-employed and you have either a SEP IRA or a simple IRA, all of those IRAs can be put in a self-directed account. It's simply a matter of filling out paperwork to move the cash from your current IRA over into a self-directed account. We also offer at Advanta an individual 401k plan for sole proprietors, and also any former employer's plan. If you worked at a job, you have that old 401k, old 403b plan. If you're no longer with that employer, you can also roll that money into a self-directed IRA and then in turn use that cash to invest in alternative assets. The one account that's not on this list is any current employer plans. If you are working for a company or an institution now that offers you a retirement plan, you may not be able to move that money while you're currently employed. That's the one area that the government allows an employer to restrict the movement of money is when you're still currently employed. But once you leave that employer, you can absolutely roll that money over into a regular IRA. So it's important to note a self-directed IRA is still, it's traditional, Roth, SEP, or simple. It's just you have the ability, the self-directed refers to you to have the ability to invest in these different types of assets. Now, the types of assets, again, we see at Advanta are real estate heavy. People, probably 75% of the assets we hold on behalf of our clients are in the real estate field, whether it's a single family home that someone wants to hold long-term or short-term, like an Airbnb, or even rehabbing it, mobile home parks, tax deeds, condos. The list does go on and on with the type of real estate, including private placements and syndications, people investing on a much more passive basis and buying into a multi-family syndication where you own just one piece of that larger puzzle. Key thing to remember about real estate before we get into this little case study is it has to be property or an investment that you're making strictly for investment purposes. You as the IRA owner and some family members cannot use the property, cannot perform any maintenance on the property. It has to be strictly for investment purposes only when you're buying through your IRA account. So you cannot buy a vacation home, a second home, or even your primary residence. And you can't lease it from yourself either. So you cannot buy a property on the beach or in the mountains and then in turn borrow or lease it from your 401k plan. That is not allowed with a self-directed IRA. Again, that extends to yourself and certain close family members as well. But to get more information really on buying real estate in the IRA, I'd encourage you just to go to our YouTube page. We have a lot of archived webinars in the past where we get into this subject much more deeply, but I wanted to leave a lot of our time today for our guest host. But just a very quick example of how it works. You have John, who has an old 401k plan, wants to buy a property down the street from his house. John knows the neighborhood, obviously he lives there, knows the prices, knows what's a good deal, and realizes, hey, I could make this property cash flow, and I don't even have to go too far to find this property. So John decides, hey, I'm going to use my IRA, use this old 401k account to buy this property. So when that happens, who does what when it comes to buying this piece of real estate? So John, his responsibility initially will be to open up and fund his Advanta IRA account. So he will go through the process of filling out the paperwork to establish the account and rolling over that 401k into the IRA. It's up to John to find the investment property and decide what he wants to purchase the property for, to make that offer for whatever that purchase price is going to be. Once he finds the property and identifies the seller and they come to agreement on a purchase price, he's going to send forms to us indicating, hey, here's the property address, here's the purchase price, and here's the name of the closing agent or attorney that is going to handle the actual closing for the piece of real estate. And then at that point, John's account manager here at Advanta will work with that closing agent to make sure all of the titling on the documents, the deed, the settlement statement, the title policy, all of that the titling is held properly in the name of the IRA. So the deed to the property will not be to John Smith, but will be to Advanta IRA for the benefit of John Smith's IRA. And so it's our responsibility at Advanta to make sure that paperwork is properly titled in the name of John's IRA account, and send it to him. And once he receives that packet, he needs to indicate his approval by reviewing the deed, reviewing the settlement statement, all of those closing documents, and giving us his approval to proceed with the closing. And once we have his approval, we will sign the documents, wire the funds to closing, and ultimately, we hold the deed and the copies of all the closing documents as a custodian. And going forward, our second phase of our what we do at Advanta IRA, we will receive all the income, pay all the expenses out of his particular IRA account. So John's investment strategy, he rented the property for a few years, getting $1,200 a month. And then after the end of 2 years, he decided to go ahead and sell it, and made obviously a bit of profit on the purchase. So it's not, the numbers aren't really important. What's important to know about this slide is that the rents that John received, the profits on the sale, all of that comes back into his IRA account with no tax consequence to him at all. This is income that's being generated to his IRA, and income to your IRA is not taxable to you personally. So all of the rents, all of the profits he made, basically on the appreciation from the sale, all come back into his IRA on a tax-free or tax-deferred basis. So again, when you're buying real estate in the IRA, it's important that the property gets purchased in the name of the IRA account. We give you that legal wording to use. The purchases can be made. You can use partners. I mean, the last example was just John and his own IRA, but we certainly have seen, say, a husband and wife or brother or sister, maybe just two business partners, join in on a purchase together, both using their IRA accounts. That is certainly possible. And just again, all the income, the rents, the profits from a sale, all comes back to the IRA with no tax consequence to the IRA owner. And any expenses, the maintenance, the property taxes, the property insurance, all of that must be paid from the funds in the IRA as well. So again, Advanta, as the administrator of your account, will receive and deposit the income, and we will pay any expenses as directed in this case by John. So if John, moving forward, has bought this property in the IRA for property management, he could elect to have a deal with the tenants himself, have them send the rents to his IRA, to keep track of the expenses and direct us to pay those bills out of the account. Or John could look at hiring a property manager to oversee that income and expenses. And our guest host today, I'm going to bring Gregg on here in just a moment. Gregg Cohen, the co-founder of JWB Real Estate Capital. His firm does do some property management, but I'll let him explain a little bit more about what they do as a business here in just a moment. But a little bit about JWB Real Estate. They serve over 1,000 clients from over 43 states and 13 countries, managing over $350 million in assets, including turnkey rentals, and even some private lending, which is something we didn't talk about with the IRA side, but your IRA can be a private lender. Again, check out our YouTube page. You can go there, you can find a whole hour-long seminar on doing private lending inside your IRA. Again, JWB by the numbers, they purchased over 3,000 investment properties, they've renovated over 2,000 properties, and they've built over 500 new construction homes, and currently have over 3,000 properties under management. But this time I'm gonna let Gregg talk to you a little bit more, and I'll turn this over to Gregg. Gregg, please I'll share your screen here, and I'll look forward to hearing your presentation. So Gregg, how you doing today?
I'm doing great, Scott. What an honor to be here with you and with all of your followers and fans and clients of Advanta. It's such an honor. Thanks for having me.
No problem, Gregg. I'll turn it over to you. You have control. I can see your slides just fine, and go ahead and move forward.
All right, fantastic. So let's make sure we've got this going here. So today, everybody, where I thought I could provide the most value is to do a topic that is really important, but is not talked about a lot, at least in the rental property investing space. It's how to evaluate home price appreciation when investing in rental properties. And so I'm going to come with some real world experience, some data, some ways to show you how you can do some of this research yourself to make the best decision on the market that you're investing in. And for any of those who would like to follow along more about what we do, you can check us out on our Facebook group right here. You can go to jwbrealestatecapital.com/group, where there's more information just like this. But I'll give you a little bit more information on kind of who we are as a company. Scott, thanks for shedding some of those things that we've done over the last 15 years. We've won a few awards and been on the fastest growing list, and Best Places to Work is a really important award for us. 7-time winner, best places to work. And but some of the most important and the most impactful awards for us are really about what we can do in the community. So thought I would just kind of share that. And so one of our things that we're most proud of as a company, so you guys can kind of see how we make decisions really. Over the last 15 years, we've built up a successful business, been able to help out others, and we really feel that we have a social responsibility to help out others who might not be as fortunate. And that's the type of clients that we want to attract as well, as I know you do at Advanta. So one of the very coolest things that we have ever been able to do is we started our own charity 3 years ago now. And when we started this charity, we had no idea the type of impact we'd be able to make. We first had our first charity golf tournament, and we raised a little bit over $30,000, and we partnered with a wonderful charity called Canines for Warriors. And in doing this, we said, man, this is amazing. We had all of our clients and our sponsors and our team come together and do something really great. And that was the first year, and we were just blown away. The second year, we said, how can we do it a little bit better? And this is when it got to be really fun. With the second year, which was last year, we actually got our entire network together, and we were able to build a new construction home and give it away to a wounded warrior. That's what you kind of see here on the screen. There was so much positive press, and I can tell you that this gentleman in the picture that you see here, Rick, who was walking with his dog Berkeley, the experience of getting to meet Rick and to see how we were able to make a positive impact in his life was life-changing for my entire team. You can see here, not only did we just build this house and raise the money and all that good stuff, but we actually worked on the house together as a team, which is really important if you get to know a little bit more about JWB, our team and our culture, and actually doing the hard work behind just raising the money is really important to us. And Rick, and this is a little bit about our team here. We were getting all muddy laying sod that day, but this is what Rick had to change, and this is really the purpose for why I feel like it's important to learn about how to invest well. It's because of the positive impact you can make on others. So Rick said that this has been a rebirth of sorts for him and that we saved his life. And I can tell you, when a military man takes you to the side and shakes your hand and says that you've saved my life, he also told me that this team, our team, the type of people he would give his life for, those words, Scott, I will never forget. It was just an incredible opportunity. So that's really where our heart is, and that's how we make decisions as a team, and certainly hoping to get to know more and more of you throughout our working relationship, not just today, but even beyond that. So now what I wanted to share with all of you through my experience of talking with thousands of investors across the country over the last 15 years, here's what I've learned about rental property investors. Number one, we're searching for something that's much different than what people are searching for when they go to the stock market, right? Scott, as you were talking about how many opportunities you have to invest in your self-directed IRA outside of the stock market, how thankful are you that you're doing this service for others in a stock market environment like this, right? Where people have taken a 30% haircut. How does that make you feel?
No, I mean, I think again, it feels good because we are providing that service to people, and I think it's certainly what the people have found. There are we've actually had an anecdote from a client the other day just saying how thankful they were. And had they actually put a lot of their family into real estate, not just in the IRA, but in general, and how all of their family was thanking him because he was knowledgeable and saw that did this for them 5 to 10 years ago, and so with all the turmoil and going on in their lives, they're not having to worry about their stock portfolio or whatever because that's not where they have their money put.
It's an amazing feeling. I have the same feeling with our investors, and I started to learn about self-directed IRAs really early on in my career, 12, 13, 14 years ago, and I've been an avid investor in my self-directed IRA and some of these alternative channels, and I am so thankful for the service that you provide and others to learn about this way of investing, so that you're not so limiting, you're not forced to be in the stock market, and ultimately for me, it delivers peace of mind. Not watching that stock ticker and knowing that my assets are safe. So, and that's what rental property investors are specifically looking for. They are attracted to consistency, right? Over the long haul in the stock market, you do earn a decent rate of return, right? It might be 7%, 8%. That's really what the numbers will show you. But it's the variability along the way that keeps people up late at night. And of course, what we've seen, especially with the coronavirus impact. So rental property investors are different. We're looking for consistency. And we love the fact that rental properties have a high floor and that it is known to be a consistent asset class. We also love numbers. And if there are simple numbers, we love it even more, right? We love simple numbers. So simple numbers might be, what's my rental income minus my expenses? That might include your, if you have a mortgage, right? Your principal interest, your taxes, your insurance, your property management fees. That all makes a lot of sense for us. We can easily calculate our return on investment from our rental income. But if you ask people, rental property investors, to talk about appreciation, most people don't even have that conversation. They don't acknowledge it. And what I wanted to share with everybody is that that's absolutely the wrong approach. If your purpose for investing is about long-term investing, if it's about long-term value, if it's about long-term gains, and you are not paying attention to which markets historically appreciate more than others, you're missing the boat, and it will cost you a lot of your hard-earned investment dollars. So that's what we're going to talk about today, is the effect of home price appreciation on your assets, and how you can be equipped to find that market or those markets which are best suited to take advantage of historically accurate average appreciation rates.
Hey,
Okay?
Greg, I got a quick question for you. So when you think about, you mentioned, a lot of investors aren't really focusing on appreciation. What percentage would you say maybe do? I mean, you say more, or what's the divide between, a average real estate investor? What's the chance that they're thinking about appreciation, or are they just more concerned about cash flow?
The vast majority of folks are thinking about cash flow because it's the easiest. And, when people come to a market, like we're going to talk about Jacksonville, Florida, which is my market, right? Jacksonville is more of a balanced approach, which is cash flow and historically higher appreciation. The folks who come to Jacksonville understand the bigger picture, and a higher percentage actually pay attention to the home price appreciation. But I'd say overall, if you polled, the 10 real estate and rental property investors in a room. I'm completely making this up, but what, 72% of all stats are made up anyways, right? I'd say a healthy majority, call it 7 out of 10, are going to say, you know what, I only pay attention to the cash flows. I only pay attention to the rental income. It's definitely the majority of folks, and that's the way they think.
And do you think that's because it's easier to calculate? Sometimes it's a little more difficult to dig deeper to find the appreciation numbers.
It is. It's difficult to calculate. The other thing is, as a society, right, we're dealing with something very disruptive right now in the coronavirus, right? But we were also greatly disrupted during the Great Recession, right? And what people took from that experience is that I can't count on home price appreciation because I saw it drop. And, home price appreciation in the short run is speculative. It is speculative. But the people who are coming to rental property investors are thinking about the long haul. If you look at values over a 10 or a 20-year market cycle, and this goes back over multiple market cycles, you're going to find that there's consistency in home price appreciation. And that's the key nugget that a lot of people don't realize. So they're concerned. They feel like just because they went through 2008 that you can't count on home price appreciation because they haven't expanded their perspective. And to your point, it's because it's a little bit more complicated to think about home price appreciation in addition to rental income returns.
Yeah, thanks for that. That was, a great answer. I would encourage, again, anyone who's listening live to the webinar today, if you have any questions, just type those into the question box on your screen. We'll make sure we get them answered. But Greg, go ahead and continue.
Yeah, absolutely. Great question, Scott, and feel free to jump in. Um, and it's kind of, the slide is really a great segue there. I mean, what happened in 2008, right? And, let's kind of debunk this myth that home price appreciation is speculative. And if everybody on this webinar agrees with me on this, I would be completely surprised because this is different than what you're hearing from others. Of course, it's data driven. It is based in the data, which I'm going to show you in a second. But I would be expecting that there'd be a ton of questions about this on the chat box. So if everybody if you have some questions about this, fire those in. We would love for this to be more interactive, because the more interactive it is for you, the more value Scott and I are providing for you. And we certainly want that today. So let's think about this myth. Is home price appreciation speculative? Well, what I'm going to show you here is that home price appreciation, HPA, those rates repeat themselves over the long run in an MSA, right? An MSA is a region, an area, a city, or a county, whatever is more suitable for where you're investing. And what that's saying is that what you're going to see in history, the home price appreciation over the long haul is going to repeat itself if you're in this type of investment for a market cycle, 10 to 20 years, which is what our investors are certainly looking for. Here's a graph of the US average home sale prices from 1988 to 2018. All right, and the blue line is the average sold price. The red line is the US home price appreciation, which on average comes out to 3.75%. So this is a long cycle here, right? Much longer than one real estate cycle. A real estate cycle is 10 to 20 years. This is 30 years. So you've got a longer cycle here. And what you're seeing is that there's incredible consistency all along this graph. Now you may be saying, well, this is across the entire country, right? I wanted to show you the bigger picture first. It's really important that you don't make decisions across an entire country, because there are no national real estate markets. There's only local real estate markets. But I want you to see the bigger picture here, that real estate is consistent. The next thing I want to implore all of you to do is to look up your own market's home price appreciation over the long haul. And I've certainly done this in some of the stats that I'm going to share with you here on my market, which is Jacksonville. But if you all would like to do this for yourselves, I would highly encourage it for you so that you make the best decisions. You can go to the Federal Housing Finance Agency site, which is right here. It's fhfa.gov, and there you'll be able to find a housing price index tool that will allow you to look up your own market's home price appreciation over the years. Incredibly valuable. So in Jacksonville, Florida, if you use this tool and you go back to 1991 all the way through today, you're going to see that on average, Jacksonville's real estate market has appreciated at a clip of 4.32% each year. That is not overall, that is not over that many years, that is each year on average. Through the ups and the downs, we've been at about 4.32% appreciation. Now here's what I want you to pay attention. This is the local real estate market and the pricing graph in Jacksonville. And for all of you, you can use that tool to develop something like this for yourselves. But what you're seeing here are the median home sales prices from 2001 all the way through, and this went through 2019. Okay, and you see those blue lines are the actual median home prices. And in 2001 and to 2006, Scott, what did we see happen for home prices across the country and in Jacksonville?
They went up.
They went up, right? That's actually the time that JWB formed in 2006. Right at that peak right there was pretty much the wrong time to be starting a real estate investment company, and my business partners and I nailed it. That's when we started. Now, luckily, what we did is we understood the importance and the weight and the fundamentals of investing in rental properties for positive cash flow, right? We weren't out there speculating and trying to flip and all that good stuff, right? It was about rental properties for us always. So that was the 2006 spike. 2006 to really about 2011, 2012, we saw the drop, right? It went from about, we had about 35% from the peak of 2006 to the trough of 2011, 2012 as far as pricing. And since then, you've seen, because of a lack of supply in the market, you've seen prices continue to rise. But the big takeaway here is going back to that question, that myth that I want to debunk for you, is that overall housing prices are speculative. That's a myth, that housing prices and appreciation are speculative. If you're investing in a market cycle, I don't believe that. And the data shows that you shouldn't believe that either. Because if you look from 2001 all the way to 2019, that red line right there is the average home price appreciation for the historical home price appreciation average, which is 4.32% in Jacksonville. What that's saying is that if you had followed that line all the way from 2001 to 2019, you'd be right about there. If you look at the average home price appreciation in probably what will be the most volatile real estate market I expect we'll ever see, from 2001 to 2006, the run up, to 2012, the trough, the fall of prices, to the subsequent run up, we are still at over 4% appreciation in Jacksonville. And so this should give you the confidence to know that real estate markets tend to repeat themselves over time. Unless there is some dramatic shift to the way that a local real estate market changes, you're going to see that history shows you that real estate markets tend to repeat themselves when it comes to home price appreciation. Make sense, Scott?
It does. And hey, Greg, we had a couple questions pop up here. Maybe we can address them since we're talking about it. Someone was asking, says, the question is, do you just take into account for first year appreciation to calculate total actual rate of return which captures cash on cash return, taking into account equity build, appreciation, and positive cash flow.
Great question.
Okay.
Yep, I can run with that one. So I think the person who's asking is talking about when you prepare an evaluation with the return expectations for a client, do you include home price appreciation in your return expectations? Um, and the answer to that is no, we don't. For JWB, we set our return expectations based on the rental income. So our clients are expected to earn between a 7 to 9% return based on the asset just from the rental income. And that appreciation overall, while it's incredibly important to evaluate here, we count that as just a nice bonus on top. So the answer to that question would be no, we don't count first year appreciation or any appreciation into the return evaluations that we share with clients when they purchase homes.
Okay, and I had another one. I mean, it's kind of what you're doing now, but how do you? The question is, how do you evaluate appreciation over a long period of time? We see this graph, obviously, that's covering 18 years.
Mm-hmm.
So and maybe that question, not necessarily how you evaluate over a long period of time. You have that you just click back to that slide with that great website to go to that has the data. Is it something where someone has to consider their, how long, say I'm X, this is my age today. I want to invest in real estate for the next 10 years, the next 20 years, et cetera. Is there a time component for the investor needs to consider in order to properly evaluate the appreciation over a long period of time? We can see obviously there's dips here and there.
Right.
Um, and I guess maybe that's the question is how do you evaluate appreciation over a long period of time? I guess it's kind of the question as well, though. What's a long period of time? Is that 5 years, 10 years, 20 years,
Mm-hmm.
or even more?
That's a great question. It's kind of a two-part question. So let's talk about how to evaluate it first, and then what is the right time to hold for this type of an asset class. So how do you evaluate it? Just like you were mentioning, I would encourage everybody to go right where I went to pull the data on this many, many years ago. The Federal Housing Finance Agency will give you the basis for what your market has appreciated over the long haul, much longer even than a market cycle, right? You'll go back probably 30 years or so. For your market, depending on what data is available. So that would be a great thing for you all to do. And then how long should you be investing? For our investors, in order to be able to get the benefits of appreciation, I tell people that this type of an asset should be held for a 10 to 20 year period. That should be the goal. Now, every investor who buys a property with us owns that asset. So it's not something that is tied up. They actually could sell that asset at whatever point in time. At a bare minimum, when we bring clients on, we ask them to commit to at least a 5-year hold. And the reason, though, that we do that is because I want to set investors up for success. Because real estate is an illiquid asset. It is something that has cost to sell. And while appreciation does happen in the Jacksonville market, I don't count on it in the short run. I only count on it in the long run. And so I think it would be irresponsible for me to bring on clients and tell them that they could expect to sell it in less than 5 years and still be able to recoup their asset, not because it's not appreciating. I do expect it to appreciate. It may not, but it may. But even if it does, you're going to get eaten up in those closing costs and those selling costs, right? And the cost of vacancy while you're trying to sell it to a retail homeowner. So short answer here is I tell people to get the full effects of this asset class, be prepared to hold for a 10 to 20 year period. At a bare minimum for JWB specifically, we ask clients to commit to at least a 5-year hold.
All right, and one question it will pop up, and I'll let you get back to your presentation after that. Someone said lately they're seeing people selling property, 3-2 rentals in Florida or Georgia for really, really cheap, 30 to 60K, suggesting evaluation based on rental rates, not comps. And the question is, isn't that the wrong way to evaluate, I guess, the property value based on rental rates as opposed to the comps?
Well, that's a great question. It's not as opposed to the comps. Both need to be evaluated when setting the right price for you to be able to buy a rental asset. So the number one reason that you're investing in this asset is to produce positive monthly cash flow. So you do need to look at what the rental income is minus the expenses and to figure out what your return expectation is based on the rental income. So that's one component. But the other component needs to be that you need to be buying at market value. For a passive investment, like many of your investors are looking to do, where somebody's managing everything for you, that's what JWB focuses on. you should be paying market value for that. If you are an investor who wants to go out there and do this yourself and pound the pavement and find the asset and build the house yourself or renovate the house yourself and manage it yourself and all those components, well, then you may try to find a discount to market value. But either way, I wouldn't advocate paying more than market value, which is what is the case in some other markets. And the reason it's that way in other markets is they don't have enough home sales to justify the comparable sales approach. They don't have enough sales out there, owner occupant sales, to justify the comps approach. Whereas Jacksonville obviously is a growing market, have a lot of sales, and so we don't have that issue. So you should take both into account, both the rental price return on investment from the rental income return on investment, as well as buying at market value based on comparable sales in the area.
All right, Greg. Go ahead. Let's, and I guess someone's asking about the average appreciation between certain years on your chart. Obviously, you're spending from 2001 to 2019.
Mm-hmm.
They're asking about the appreciation between 2006 to 2019. I guess the larger question, I guess, that maybe they're asking is, I'm assuming where these data sources you're going to, there's ways to set those parameters.
Absolutely.
And what time frame you're looking for. Okay.
Absolutely. You can adjust the parameters. You can splice the data however you would like it to be spliced. But I can share with you in 2006 and 2007, my business partners and I have 3 other business partners. We were a couple of 20-somethings and no real estate experience, not much to go on. We had a fledgling company at that point, but one thing we absolutely nailed in the face of the chaos of the Great Recession was that we invested in rental properties. We bought those 40 rental properties in 2006 and 2007. I still own them today. The rents were consistent even though prices dropped, like you're seeing on this chart here. And then I still own those assets today. They have regained their value that was lost during that time. And then, of course, they've gone up in value since then. But the key point, and another thing that really brings people to rental property investing is, while prices dropped from 2006 to 2012, for those 40 rental properties that I owned, do you know that it didn't have one bit of impact on my life? And it's because the rental income was consistent. My tenants were still paying rent. And for me, again, I go back to this long-term outlook that I've always had, and I think it served me well. It serves investors out there very well. I didn't care what I was going to sell it for in 2008 or 2009 or 2011, right? I cared about what I was going to sell it for 30 years down the line, or maybe even not. Maybe I was going to give it to my kids. It didn't matter to me. So that key takeaway that there's still consistency, even when there was chaos in 2008 in the real estate market, hopefully is a big takeaway for those who are listening today as well.
Yep. Let's go. Yeah. Let's go ahead and move on. We'll keep going. Again, keep the individuals, keep those questions coming, and we'll make sure we get them asked.
Sounds great, guys. So here's another thing that you should be paying attention to. Again, I want to equip everybody with the tools to do a little bit of due diligence on your own. And of course, I've done some of it for you, especially on the Jacksonville market here. But there is a link between home price appreciation and population growth. Right? Shouldn't surprise anybody here, right? If you have more people move into an area, right, housing demand increases, and that there should be a link between home price appreciation and population growth. So if you're looking for those markets to identify of why you should be investing there, and if you're investing for the long haul so that you can count on home price appreciation in your investment decision, then you should look at population growth because it's so easy to track, right? You can look up your market's population growth by using the census. It's right there for you. So census.gov. So here is what we've seen from some of the most common cash flow markets out there for their population increases from 1990 to 2017. Which is the latest data available. And I'm pulling this information right from the census, okay? You can see other markets that are popular: Dallas, Kansas City, Memphis, Birmingham, and Cleveland, right? Hate to rag on Cleveland a little bit here, but people are moving from Cleveland. Birmingham had negative population growth, right? Memphis, Kansas City, Dallas has really substantial population growth. Of course, Jacksonville has the most population growth. As you would imagine for the point that I'm sharing with you, right? Now take a look at the historical home price appreciation for those markets as well. And you're going to see this correlation that I'm speaking about. So from 1991 to 2018, it is almost a direct correlation that the markets that had the highest population increases also had the highest home price appreciation rates over the long haul. Okay, hopefully this is sinking in with folks, and this idea of figuring out where your asset is going to gain more value over the long haul is not this speculative, you know, unknown out there, right? You don't have to be a guru to figure this stuff out, right? You want to invest in the areas that have seen highest population growths over the long haul, and also the areas that have seen the highest average home price appreciation. And those markets, the theory here, and what I've seen in my own investing portfolio, is those markets are poised to appreciate more than other comparable markets. Make sense, Scott?
Sorry, Greg. That's and I'm meat there, so I didn't get any background. Yeah, no, it makes complete sense. And I mean, people that are listening, it doesn't sound like it's overly complicated to figure this out. There's some great tools there. The census.gov and then the FHFA website gives you this information. So for your local market, or market that maybe not just your local market, but a market you're considering investing into, the resources are out there to get that information.
Absolutely. So I've taken it one step farther, and I want to put this into real numbers for all those who are listening on decisions that you could have made based on doing some of that due diligence in 1991, and what would the effect have been all the way through 2018 and into 2019 here. So I've put on this chart here the home price appreciation rates on average per US city. You got Cleveland, Memphis, Birmingham, Kansas City, and Jacksonville. As we just saw in the last chart there, Cleveland had the lowest, a little bit under 2.5% appreciation. Jacksonville had the highest, 4.3% appreciation. What I want to encourage all of you after seeing this data is to take off these cash flow blinders. That's what I call them. It's this mentality that the only thing you're going to focus on is cash flow. Because the way I feel is that if you do that in 10 years or in 20 years, for those of you who are investing for the long haul, you're going to look back and you're going to kick yourself because you could have made a decision that would have resulted in better value for you at the end of the day. If you purchased a property for $100,000 in 1991 in Cleveland, your property value would be worth just under $189,000 at the end of 2018, which on one hand is such a testament to why you should invest in rental properties, because we're able to earn consistent returns from the rental income. And even in a city where we have shown that population has actually decreased, we still saw home price appreciation over the long haul, right? If you can consider that against the other alternatives out there, like the stock market, the gains that you have from even investing in Cleveland, which has the lowest appreciation, are substantially higher, especially if you use the benefits of leverage. So a big win, I think, for our overall asset class to look at that. However, if you purchase that same property for $100,000 in 1991 in Jacksonville, your property would be worth over $313,000 in 2018. You would have received an additional return on your investment from choosing the right market, in this case Jacksonville, over 27 years. Your additional return would be just under $125,000. And putting that into real number sense is the essence of why I'm so passionate about sharing this information with those out there, because I think once you know this and you're informed with the tools on how to make this decision, you can make a wiser decision that's going to help your overall returns for many, many years. And for those of you, I know we had a couple of questions early on about how do we share our return expectations with our clients, those who are considering investing in Jacksonville. We do serve over 1,000 clients, and those clients come from all parts of the country and all over the world, actually. They're in 43 states and 13 different countries, and they all choose to invest in Jacksonville. So it is built for the investor who is not local. You can go right here, which is jwbrec.com, and you can actually view JWB properties today right on the website. You can request those, and those will be sent to you at jwbrec.com. Before I get into the next section, Scott, any questions or any thoughts or anything that I missed? How am I doing over there?
Yeah, no, doing great, doing great. Yeah, we got about 15 minutes left or so to hopefully leave enough time for you to get through that too. But one question that came up, someone asked, how closely is the HPA, the home price appreciation, related to CPI change? And I'm assuming CPI is talking about the Consumer Price Index, or unless I'm not aware of another acronym for CPI. But do you have any information on that? How again, the question, how closely is HPA related to CPI change? Or if that's something you ever look at?
I'm wondering what correlation they're trying to draw there. I would think a stronger correlation would be between affordability of an area. I don't have data specifically on consumer price index. I don't really see the correlation there between home price appreciation. Um, but I would see more of a correlation to affordability of an area as well. That's a big reason why people actually move, population grows in a city like Jacksonville is because we're very affordable. You're seeing a lot of net migration from the Northeast down to the Southeast because it is more affordable in the Southeast. So that would be a leading indicator for population increase, in my opinion. So I'm not exactly sure the source of the question, but I hope that helps a little bit there.
Okay. Yeah, let's go ahead and move. I have a couple other questions came in, but I think I'm going to hold those for the end. So I'll let you go ahead and keep moving.
Yeah, absolutely. So, we've talked a lot about the numbers and how you make the right decision for the market. I think I'd be remiss if I didn't talk about the right type of an approach if you want to be passive, right? That is, I think, one thing that separates our clients at JWB. They do not want to be active real estate investors. And so if you're somebody that wants to get out there and pound the pavement, JWB might not be the right fit for you. And for those who want to be passive, that means that they want to work with a team that's going to be able to handle everything that comes along with their portfolio. Those are the types of investors that we work best with. And when we do that, we want to understand why they're investing. And I always ask people this, what is your why? What is that reason that you're choosing to buy a house, to own it for 10 years or 20 years and for somebody else to live in it, right? there's there's a lot more fun things that we could do with our money than having somebody else live in our house. And the only reason you do that is because there is a big long-term benefit. Um, and what I call that is that's your why. So for many people, they may say it's early retirement. Um, it may be taking trips around the world. It may be having more charity of a more charitable aspect, doing things for my kids, right? Those are really common. But I always ask, what's your why? And I want to know more about it. My team wants to know more about it because it helps us know why we're serving our clients so well. So I was going to share a little story here about Liz and Steve. Liz and Steve, two amazing clients. When I asked them about their why, they said, well, I want it to be early retirement. And they came to us, I think maybe 7 years ago, 8 years ago. And I said, well, Liz and Steve, I'm not going to let you off the hook here. I want to know a little bit more. Early retirement, it sounds good, but what are you going to do when you retire? And they said, well, here's really what we want to do. We want to build up consistent income coming in. We love rental properties. So they bought 2 rental properties with us. And they said, once we believe that this income is consistent and we can count on it, what we're then going to do is we're going to sell our personal residence. We're going to go buy a sailboat, and we have wanted to sail around the world for so long. And if you can nail this for us, if you can create consistent income for us, that gives us the peace of mind that we can go ahead and sail around the world. So as you can imagine where the story is going, that's exactly what Liz and Steve have done, which is interesting. It's an amazing story. It also creates a little complications for the way that we serve our clients because, most property managers out there, let's face it, they are, customer service is not their strong suit, right? Most property managers out there are, mom and pops or accidental property managers is a term that you see a lot of. They were real estate agents and they turned into property managers. And customer service is not normally what their strong suit is. We take a completely different approach with JWB. We call all of our clients on a routine basis once a month for sure. And the conversations are not just, hey, did your tenant pay rent? It's, hey, how are we advancing you to get to whatever your why is? So for Liz and Steve, they now are across the world. And the only challenge here is that we have to find out where they are in the world so they can turn on the internet capabilities so we can find which port they are in the world. So it's always a little bit like, where in the world are Liz and Steve this month? And they send pictures about all the cultures that they're experiencing. Right now with coronavirus, their plans have changed obviously right now, but that's a temporary thing. and they'll be on that. So this type of an approach, this type of a why is what we get so excited to serve, at JWB. So thought I'd share with you what their returns have been and what that type of consistency is so that they can make that decision for themselves. And this would be something I would hope for all of you as well, to be able to accomplish whatever that why is because you have consistent income and effective management in place. So they invested a little bit under $200,000. And as you can see, this reporting is something we offer to all of our clients on a monthly basis. We're able to see exactly what their return on investment is, specifically from the rental income. And you can see here that we keep track of what we told them it was going to be when they invested with us, which is really cool. You get to hold us accountable to it. We told them to expect about 7.5% returns, and they're just a shade under 8% with an incredible amount of consistency throughout the years here. And again, this is only from rental income. This does not include home price appreciation. My stance on this is that the asset is great enough if you only focus on the consistency of the rental income, and then you should look at home price appreciation over the long haul as a nice bonus on top.
Hey, Greg, and a quick question on that. When you were talking with that couple about their rate of return, obviously you're showing that based on the cash flow. How much did the home price appreciation factor in to what property they were buying as well? Was it, again, was that decision made pretty much just on the cash flow? That's the rate of return? Or did they also say, hey, we want to have, we want the consistent cash flow, but we also want to, again, at the end of 5, 10, 15, 20, 25 years, whatever it may be, to have that built-in appreciation as well? Did that go into selecting what properties for them to invest in?
Well, so the appreciation conversation really is a macro conversation with clients that come on board. And it was the same with Liz and Steve, right? We're really, really focused on under promising and over delivering. And so what I share with folks is, I don't have any data to show why one property that you could purchase with JWB in Jacksonville is going to appreciate more than another property in Jacksonville, in another one of our neighborhoods, right? I think that would be speculative. And I also think it'd be speculative to say over the next 3 years, this property is going to appreciate more than that property. So we really don't factor on a specific property basis. We don't talk about what you should expect as far as appreciation because it doesn't matter in our opinion, right? If you're investing in the long haul, Jacksonville's market overall should go up in value right in lockstep with what it has done on average. So the answer to your question is, from a macro percentage, that's part of the reason why people come to Jacksonville, is because we expect to have more appreciation here than in other comparable cash flow markets, so it factors in there. But then when it gets to actual property selection, it is all about the returns, and it's all about that specific asset that we purchase. And we don't inflate our return projections to count on any appreciation. It's just a nice bonus. And Liz and Steve have enjoyed that nice bonus, many, many years after they originally purchased the property.
Yeah, another question somebody had kind of, I guess an overall, what fees do you charge? Obviously there's a return part of that they're getting for that property. What do you charge at JWB to them for your services and doing that management of the property?
Absolutely. So, anytime you're going into what I would call a passive investing situation in rental properties, you're going to be hiring a property manager. And I'll share with you sort of how the industry standard goes for fees. And JWB is right there with the industry standard as far as fees. We just hope that you would agree we'd be giving you much more of a premium service. So you're going to have a property management fee. That includes everything about the relationship with the resident that we would be handling on your behalf. Your resident would never know who you are, would never be contacting you because that's the way you want it. We charge 10% of the rents that are collected for that monthly management fee. And I should include that fee, along with all these fees, are included in your original return expectations as well. So it's included in there. Those net returns, those 7 to 9% returns, are after including these fees as well. You're going to find a tenant placement fee as well. Tenant placement fees on average, we are at 1 month for tenant placement fees, but you might find some other operations that have less than 1 month for 1 month's rent to charge for a tenant placement fee. But here I wanted to give everybody a little bit of a nugget too. So some operations may charge like a half a month's rent, but ask them about what their duration of leases signed are. The way you win in rental properties is by signing long-term leases and keeping paying residents in your home for the long haul. So at JWB, we only sign 2 and 3 year leases, and we charge a full month's rent. You're going to find in other property management outfits, they're going to charge either a full month's rent or sometimes a half a month's rent, but they're not going to sign long-term leases. And hopefully, Scott, you'll have me back at some point again. We can talk a lot about long-term leases because that's a completely different approach than others have, but it really matters for long-term value as well. So to clarify, 1 month's rent for JWB tenant placement fees, and then there are lease renewal fees. When we renew a lease, that is one of the best things for your return on investment. We charge, it's a sliding scale, so if it's a 1 year lease renewal, it's only $200. If it's a 2 year lease renewal, it's $400. If it's a 3 year lease renewal, we get somebody to sign up for another 3 years, that would be $600. It's $200 for the length of the renewal. And those are the fees.
Right, great. Yeah, so I have a couple other questions here too. Someone want to know if someone had like a 5-year investment plan for real estate, is there a way or how can they participate with the gain in equity during that time? Is there a specific strategy they could utilize or something you had in mind where they could do that? Someone say, I just want to be in there for 5 years, so they're not going to be able to be there for the long haul. How can they still participate with that equity gain?
Yeah, it's a great question. And we do set the minimum at a 5 year hold. So if there are folks who are interested and have a 5 year horizon, that's okay. 5 years gives you enough time to build up the equity within the asset, both from a potential appreciation perspective as well as the pay down of your loans. That you should be in a good spot, and we feel like we're putting you in a position for success. So if you have a 5 year hold, that would be great. We would love to chat with you about it. If it's less than 5 years, that's out of service to everybody on the call. I really wouldn't advise buying a rental property and planning on holding less than 5 years. I care too much about setting you up for success to say anything else.
Hey, Greg, I want to give you a chance to make sure. I don't know if we're at the end of your slides or if you have any more. We'd get through because we did have a couple of questions and we're running up against kind of the end of the time we allotted. We can certainly go a little bit longer, but I wanted to
No,
make
this
sure
is
if
all.
you had it. This is it?
We're good.
Okay,
Yep.
good. So yeah, one people asked the best way to contact you, I guess through your website, or do you have a phone number for them to reach you?
Absolutely. So our phone number is 904-677-6777. You've got our homepage right here. This is our website. It's jwbrec.com. You can also Google us at jwbrealestatecapital.com. And then the other way to find us is the group, the Facebook group. And that one is jwbrealestatecapital.com/group, or you can just go on Facebook and type JWB Rental Property Investing and find us there.
Yeah, and I had a question. Actually, I can take it. Someone asked. They said they missed the beginning part of the call. With an IRA, what can I do or not do regarding the property? For that the person asked that question, if your IRA is buying real estate, you just have to make sure it is strictly for 100% investment opportunity, whether it's for rental, whether you're rehabbing, whether it's short term, long term, whatever the case may be. It has to just be for investment purposes. If your IRA is buying real estate, the simple things you cannot do is you cannot live in the property, you cannot rent the property from yourself or from your IRA account. You can't lease it out to certain family members. So really the restriction is when it comes to an IRA owned piece of real estate is that personal use or allowing a disqualified person to in any way use the property. And beyond that, as far as maintaining the property, your IRA should have third parties, cutting the grass, replacing the roof, painting the walls, etc. So I'd encourage that person, give me a call separately. I'm happy to answer that and go through that process as well. Another great questioning for you, Greg. Someone said, is there a correlation between the return on investment and the cost of the property? So is there a difference in ROI for, say, a $100,000 house versus, say, a $300,000 house?
Yes, great question. So we focus on middle income to below middle income housing. And the reason we do that is because that ratio that you're speaking of works and you can produce positive cash flow because you have demand for rentals there from people who want to live in them, and that brings your rental income rates higher compared to what the price of the property is. And that's an easy way of saying that, that's positive cash flow right there. So middle income to below middle income. If you go higher than middle income, what you're going to find is that the demand for renting in those areas is not as strong. So your correlation between your rental rates and your pricing is not going to be as strong, and you would have negative cash flow. And that's why we don't do that. So the purchase prices for a JWB asset is between $160,000 to $200,000. That is that middle income to below middle income housing in Jacksonville. And of course, you'll figure that out for your own individual markets out there. But in Jacksonville, you're not going to see rental properties at, well, not through JWB at $300,000 because we couldn't accomplish the first goal, which is positive cash flow. It's a great question there.
And last couple of questions I have here, I think all kind of go somewhat to what the services you provide. So someone's asking, do you help find rental properties? Do you help in the property buying process or just in the managing process? And do you handle the bulk of the transactions and the commissions once a property is identified to become part of the portfolio? So maybe give just again a little bit overview of what JWB does in acquiring the property, going through a closing, and then ultimately in managing that piece of real estate.
Absolutely, and I'll put myself in the shoes of somebody who may be listening or maybe an investor. If you've got, let's call it a pile of money out there that you're not happy with the way it's performing, it might be in the stock market. You come to JWB, we build a plan for you for how many rental property assets you need, and then everything is done for you so that you can start to acquire assets. So in the background, and this is not anything that you would be a part of, but prior to working with you, JWB has already purchased the land. We have then built new construction houses. We have then put tenants in place, and it's positively cash flowing. By the time we would be speaking with you, we would have your plan in place. You would be able to make a decision on how many of those assets you would like to add into your portfolio. So you can think of everything being done so that it's completely hands-free and passive for you as a client. And then JWB is also your long-term property management team. And it is one team. Everything is under one roof. It's the same owners of the company. We do not outsource property management. It's all there because we feel like that is the only way that we can really deliver value for clients out there. And then there was one question about fees and commissions. There's no commissions because you're buying directly from the seller, which is JWB. It's a simple purchase and sale. JWB would be selling that rental property asset or that portfolio of assets to you, and you'd be purchasing it. So there's no need for commissions. So that's always nice for everybody there.
Yeah, and another question just popped up. Well, somebody asked, do you have properties other than in Jacksonville in Florida? And then someone asked, kind of on the risk factor, so the question is, isn't owning only one or two rental properties risky? Like if a tenant trashes the property, or I guess you have long-term vacancies, I guess how does an investor mitigate some of that risk?
I love that question. I'm going to take that one first. I tell clients before you come to rental property investing, you should have a plan in place to own at least 3 rental properties to be successful. And I share that with them again because I'm so concerned about your long-term success here. If you don't have a plan to own at least 3 rental properties, you shouldn't be investing. Because if you only have one, you're not going to be consistent. And consistency, as we started this webinar, was the reason that people are coming to JWB and coming to this asset class. And it's impossible to be consistent, right? If you only have one rental property, because we're going to be overperforming when your resident is in there and paying rent, and then eventually your tenant's going to leave. Your resident is going to leave, and you're going to have a down year. And that type of variability is what we're trying to avoid. So we do sell properties on an individual basis to clients, but we do that with the plan in place that they are ramping up over the years. I mean, when I started, Scott, I was 23 years old and I bought my first rental properties, and I needed to buy one in the beginning. And we love working with those clients that either if they're younger and they can only buy one, or if they're a little bit older but they still want to buy one right off the bat, we love working with clients, but we're very, very proactive in letting them know that for this to be successful, really within a 1 to 2 year time period, we do need to see you at 3. So what that means is, as far as if you're buying and you're getting conventional financing in place, and this You can't actually do that through your self-directed IRA, so it's a little bit different. But at a minimum, you should be planning to invest somewhere around $100,000 towards this asset class, which would be 3 down payments at a minimum for your rental property portfolio over the course of the first 1 to 2 years. And that's how you mitigate the risk of one tenant leaving while the other two are overperforming, and that's how you create consistency there. And then the other question was, are we going to other markets? Do we already go to other markets? And everything about JWB I find is a little bit different. Our approach is a little bit different than others out there. There are many other outfits that try to have different inventory in different markets, and that's sort of a common thing to do because they're struggling to source inventory. We don't have that problem at JWB. We have actually been stocking up and stockpiling inventory for our clients for many years now, so we don't run into that problem. And our heart is in Jacksonville. And we believe we can reduce risk by focusing solely on the Jacksonville market for our clients. And we believe we can make the biggest impact in our community here in Jacksonville. So we don't go to other markets, and we only focus on Jacksonville.
All right, that answered one of the other questions that pop up. The last one will leave you a little bit of a tough one, I think. But someone was asking, if all properties are positive cash flow, why does JWB not simply retain the properties and enjoy the cash flow as opposed to selling those properties to an investor for them to enjoy the cash flow?
Great question, great question. So I own over 300 rental properties. I consistently build them up year over year. Started with 40 back in 2006 and 2007, and have continued to add to our portfolio over the years. So I want you to know that we continue to do that because we believe in this asset, and it just seems weird to talk so glowingly about this asset and try to help others if you're not doing it for yourself. So we do that. We do that. And of course, we make this opportunity available for other clients as well. I feel like we have a really great thing and a service to provide for others to package this up, to create an asset class that you didn't know you could take advantage of. And so that is why those are the assets that we sell to our investors as well. So we do both.
All right, Greg, I'm going to take back the screen here, and hopefully we're showing the right. I'll put it. I know we had an issue with that earlier. There we go. Hopefully this last slide. I want to thank everybody. Yeah, I want to thank everybody for coming on today and listening. Like I said, the recording will be sent out by email in the next few days. So everybody who listened live, you get a chance to rewatch it. Greg, I want to thank you for your time, and obviously we'd love to have you back at some time to talk more about other areas of real estate. So everybody who's listening, look for those events obviously to come up as well. Here's my contact information. Again, I'm Scott Maurer with Advanta IRA. If you have any questions on the IRA side of the business, buying rental properties, buying rehabs, just general IRA questions, give me a call, shoot me an email. I'm happy to answer those for you. But Greg, I'll give you a last comment here, and then we'll close it down.
I just want to say thank you for the opportunity, Scott. Wonderful privilege to be here with all of your listeners and your fans and your clients. And I hope everybody goes to does a little bit of that due diligence. And I hope you listen to what we were talking about today, because I truly believe it can help you make better decisions long term.
All right, Greg, thanks again for coming on today, and we'll look forward to having you on again in the future.
All right, take care.
Thanks.